Welcome. My name is Sasha Moore and I'm here with Andrew McVeigh, who is the managing partner of the investment management business Remara. Welcome.
Great to be here, thank you.
Pleasure. So what I'd love to understand today is a little bit about the investment structure and philosophy that you've applied to the Remara fund.
Yeah, certainly. So our investment philosophy in private credit is one that we're looking at gaining exposure to the entire market. So we see a lot of competitors at the moment that focus on specific credit verticals. So what that essentially means is they will originate and invest into real estate loans. So maybe construction first mortgage or second mortgage, land banking, or everything within that real estate space. And what that essentially does is it provides a lot of significant concentration for investors into real estate or into specific projects based on the size of those projects. So our strategy is one where we align ourselves with a number of originators, and we do that through having equity ownership in each of those originators, and we're looking across the entire credit spectrum. So we're taking more of a macro view of the Australian economy and more of a macro view of the entire credit spectrum in Australia. So what we're ultimately looking at providing for investors is a fund and an investment where you're not taking individual credit style risks, and we're really trying to offer something that is diversified, so the risk that you're ultimately taking is systemic, economic risk. And that's something that we believe we can actually take and achieve through the diversity of loan products, through making sure that we don't have single geographic concentrations, single industry concentrations, single asset or underlying security concentrations. And it's something where the mix and the pool of the loans that we've actually got gives a very, very strong diversification element to it, and ultimately means that then flows up through to investors and provides liquidity because we have loans maturing on a continuous basis. It provides diversification because, again, we don't have single concentration levels in any one asset or geography or loan type, and it also enhances the yield overall. So ultimately what we're trying to do is provide investors a private credit fund that meets the needs of enhanced yield, lower risk profiles, but also floating rate nature. So that means that as the RBA rate increases or decreases, the fund return moves with that. So while interest rates were at zero, we were returning investors around the 7 to 8% mark. Now with interest rates at 3% or circa 3%, we're returning investors between the 10 to 11% mark. So essentially we're able to move with the market, and that's quite an important feature with the undecided nature in terms of where interest rates are actually going to go. And that's actually boded very well for us and our investors over the last 6 months or so, while we've all faced kind of that rapidly rising interest rate environment.
Okay, interesting. So you raise an interesting point about the market volatility. Mm-hmm. What are you finding in terms of the investor appetite for this type of model?
I think it's a fairly new investment for most underlying investors. I think a lot of people have had exposure in and around the construction side and the real estate side. We saw banks move out of the construction market pretty readily post GFC, and as a result of that, we've seen a plethora of credit managers who have moved into that market. So I think most people understand and are accepting of real estate specific, particularly around construction and first mortgage, land banking, those types of things. But what they haven't really experienced is all the other credit products that are on offer within Australia. So that might be SME loans, asset-backed securities, residential mortgages and mortgage-backed securities, syndicated corporate loans, those types of things. And that's essentially what we're trying to bring into one combined pool. So we don't have the single concentration in real estate. We have that as essentially a sleeve of what we offer, and we can get the enhanced yield from that and the pickups that you traditionally get without having all of our exposure into a handful of construction assets where if you do have a problem, you could suffer a capital loss.
Sure. Okay, thank you for your time.
Thanks, Sasha.